Hello, my name is Brian Frumberg. I'm the CEO and founder of VentureOut. I'm very excited to be here today in a virtual version of the VentureOut Incubator, speaking as a part of the Softland Expo 2020 and talking about a topic that I care a lot about, a workshop that I've given like 9 or 10,000 times. About raising US capital as a foreign founder. There are a lot of tidbits in here. This is typically like a 45-minute session that I will be trying to get done in the 16-minute time limit I've been given, which reminds me I need to get my timer started here. There we go. And let's jump into it. So, and talk about how to make some money or raise some money. So I'm going to talk a bit about raising capital, about some tips and tricks for working with investors, an understanding of what red flags they look for, what you want to communicate to get them excited about you as a potential investor, considerations as a foreign founder, and then I'll finish by talking a little bit about VentureOut because the topic is probably of more interest than me and the company. So I like to start any talk about raising capital by talking about why venture is like a sales process and how a sales process always starts with understanding your customer. And a lot of the times founders are so engrossed with the day-to-day minutia in the weeds, working on their company, that they have a challenge putting themselves in the shoes of investors in the way that they may, if they run an effective sales process, put themselves in the shoes of their prospective clients. And the first thing you really want to understand when thinking about investors and how they think about you is that they know that the game they play is maybe the riskiest asset class of investing. Venture is a risky game. How do we quantify that? Super exciting stat that I promise is not meant to scare people away from being entrepreneurs, but the vast majority of startups fail. The vast majority of funded and unfunded companies. And even if you look at companies that are able to raise money, this is a different definition of failure. This is failure in a VC's term, a write-off of their portfolio, a company that doesn't impact their portfolio or their return to their investors. And if you look at your average performing VC, they are writing off 80 to 95%. That means if they cut 20 checks into companies, 20 checks into 20 separate companies, they're writing off 16 to 19% of those. If you look at, say, the best performing VCs, they're cutting 10 checks and they're wrong 7 or 8 out of 10 times. And that's them being really great at their job. And the reason that can work out is because, you know, whether it's this piece or it's this piece here, right? The goal of a fund is that they make a lot of bets, a lot of them fail because it's super high risk, but the few pay off in massive terms so that they can return the entire fund with just a few deals. A lot of funds actually are looking for companies that off the bat have a market cap capability, an exit possibility that allows them to, on their own, be one company out of that entire fund that the VC is investing and return the entire thing for them. What that means for them, and this is a good thing to know when evaluating funds want to return their fund twice. So if they're investing in you out of a $50 million fund, that means that they want to return $100 million. So this little piece here will, right, the returns from these successful investments will return 50 million once. All of that goes back to the investors, their LPs, and then they return 50 million twice. That's what they consider success. That's their goal. And then they keep 20% of that second 50 million and pay 80% of that back to their investors. At least that's the sort of typical framework. So understanding, putting yourself in the shoes of US VCs, they know the game they're playing is risky. Their job is to mitigate risk, not take risk on you. Why is this important to mention? I meet founders all of the time, whether they're coming from around the US or around the world, looking to go to New York City or to San Francisco, and they think that, man, at home, there is not enough risk capital. There are not enough investors that are willing to take a risk on us and on where we are, and they have these requirements that I just know won't be the case if I can get into San Francisco or New York, where there's just so many more dollars. And that is like really false thinking. It is not like you're going to hop from Boise or from Dusseldorf into New York or San Francisco and find someone that's just going to like take a flyer on you. That's not how this works. It is a much more competitive market because you're not the only person thinking about how there's so much more money in those cities than there are in my home city. But also, and that gives them a lot of choice. And their job, again, is to mitigate the risks that they're taking, not to increase them by taking a chance on you. And so the question then becomes, what is it that, so understanding again the VC perspective, the job of a VC, as opposed to say an equity investor, is that they are activist investors, not passive investors. You can go buy stock in Google. You're not then calling, Sergey Brin to let him know what you think the best strategy is for what they should be doing with Google Maps or Waymo or whatever else it is. That's a passive investment strategy. With venture investing, they pretty much need to be able to say, after I have invested, after our fund has invested in your startup, your probability of success goes up. If they can't increase the probability of success, then these failure rates go even higher. And so the question then becomes, how is it that anyone can help your company? How is it that anyone can increase your probability of success? And typically the answer is there are two ways, and that is for anyone, an investor, a partner, a member of your team, strategic insight. I know your market, I know your product, I can help you build a better widget, I can help you build the widget faster, I can help you go to market in a better way. Strategically, I can be very valuable. Network. I know people that can be, I know the next person you're going to hire, that you're going to sell to, that you will have as an investor, that you'll exit your company to. And both of these things have a pretty tight geographic circle for most people. And so the result of that is that US venture investors invest in US-based businesses as a rule, with very few exceptions. That VC markets are really inefficient because capital barely crosses borders, especially from sort of the primary venture market, the US, abroad. And this sucks because if you carve out the sort of, unknown world and data of early stage venture investing in China and look at the rest of the planet, almost all of it's sitting in the US, especially early risk capital. Companies need to expand here to the US in order to take advantage and access that capital. And this slows the growth of communities around the world. And that sucks. So then the question is, what do you need for investment? What do you need to have a conversation with an investor and get them really excited about you? So relevance. This is really the big one, and the one that founders need to spend the most time on. How are you relevant to that investor? Stage is obvious. Business model, if you have investors that are focused on specific business models, is pretty obvious. Sector also should be pretty obvious, but there are a lot of really compelling ways that you can tie this relevance of your business to their strategy, to their portfolio of existing investments. That's really clever, and I'll jump into a little bit of that. US presence, what does that mean? A founding equity holding member of your team is in the US office. They do not want to be playing telephone with some head of US or some salesperson you hired to run the US office that isn't really making decisions when it comes to who and how much and at what value your equity is being sold. So founding member of the team in the US. There are other reasons for that. I have an entire article on why hiring a salesperson is not a US expansion strategy. Just go to ventureoutny.com/blog and you'll see the post there. And also, you want to say that you are attacking the US as a primary market. This is one that is a little more lip service. It's understood that if you have an existing business abroad, that's going to take up a lot of your time, but that your goal is that the US will become your primary market. And you have to have a defined business plan for expansion. And yes, this starts with the basics of like getting there, right? You want to incorporate in the US as a Delaware C corporation. Do not ask why now. Ask a lawyer. It's super boring, but basically all companies that want to raise money need to be a C Corp, and you want to be based in Delaware. And immigration sucked long before Trump took office. My launch event in 2012 was about immigration reform. So you can imagine how awesome things are today. And while that's the case, we've actually never had a company that wanted to get to New York or to the US that wasn't able to. So the trick is really just from the get-go working with a really good, trustworthy immigration attorney to avoid making some mistakes and to go down the most advantageous and efficient pathway to getting a business work visa here. And this is really the most important one. If you're going to go to someone that is and ask them to give you $1 million, you better be able to tell them how you are going to spend that money. How, who is it that you're going to hire? Why are those the right people? In what order? How do they fit into the broader organizational structure of what your team's going to look like when you've got 15 or 20 people in a year and a half or 2 years? Have you ever managed a team that big? If not, how are you going to do it effectively? Who is it that you're going to bring on board? What is it that you're going to teach yourself or learn, or advisors that you're going to lean on? What is your marketing strategy? You're going to be investing a lot of money in online advertising. Have you done that before? Have you tested the different channels in the US? If not, you better get answers to a lot of those questions, because it's very fair game for investors to ask you how you're going to spend that money and you to have a really defined plan on how to do that. And traction. And mostly this means revenue. Typically, you're looking at $20,000 to $25,000 of monthly recurring revenue in order to raise $1 million in the US. A lot of the time, companies we're working with don't have that. And so we're working with them to really define metrics around their clients, their proofs of concept and trials that they're running, and to come up with projected revenue numbers as a result of that, with sort of pipeline value numbers. Users obviously is a metric used more on the West Coast if there is not revenue or business model backing up that user growth. The East Coast, New York, typically want they're more business model revenue focused. And if you have a highly complex product, your frontier tech, the technology you're developing is truly the innovation, not the market or anything else. It's really the tech. Then maturity of product, the investment in that product of time, dollar value of that are things that you can get investors sort of on board with you having enough traction. And this is a constantly moving target, as in it used to be 10K in recurring revenue to raise $1 million, and now it's 20 to 25. And this is the holy grail. If you have traction, if you are rapidly acquiring users or generating revenue, all the other requirements will kind of float away because people want to get on the money making train. So relevance and research. Most people, as I said, start with this burning need. I need money. I'm going to run out of money at the end of my runway is December 2020. I'm not going to be able to make payroll or anything else. I need money. That's what I'm focused on. For my favorite movie, if you name it and you email it to me, I will pay you $20. So I need money. You, Mr. Investor, have money. Let's talk. This is not how it works. There is so much more detail and nuance that has to go into how you're communicating, even if that really is what it is at the end of the day. This is where I go to a different screen and do a very fast, because I'm going a little bit over on time, a very fast run through of, pull it up here, how it is that we actually help startups specifically. There we go. With raising money. So we do fundraising advisory for startups. Is one of the many things that we do. Right, advisory practice, working one-to-one with startups in general is a big part of what we do. And fundraising is what a lot of companies come to us for. We've obviously worked with Pied Piper because they're a real company. Also, that is a real unicorn, in case you weren't sure. And the data that sits behind this is not that of Pied Piper, but I have some sort of Pied Piper relevant examples. It's actually from a real company that we did this for. And what we do is we create a very structured list of the types of investors that we're searching for, either by finding and searching investors directly, or by finding companies that are really relevant to you but not directly competitive and finding their investors. And we find them by tagging industries that are direct, what we call direct industries. That means any investor that is tagged as relevant to animation here is relevant to this startup, any one of them. But there are other topics, like for them, hardware. Every hardware investor is not actually relevant to the company that we built this list for. But if hardware is paired with animation or children or toys, then we have sort of 2 points of relevance, and we know that that will be a relevant investor. For company searches, which you can see when the word here is company, we're again doing the same thing. We're searching for companies that have raised over $10 million, because then we know that that company has gone on to find some success. A $10 million raised typically means a $30 million valuation. And so the investors have seen, especially the early stage investors, have seen the ride that that company took, saw some of the challenges they faced in growing. That is what we call a very smart investor. So to jump into Crunchbase, all of these searches that are relevant, we actually save. And why is saving these searches awesome? This again is in Crunchbase. They are not sponsoring this presentation, but they are awesome and we use them all the time. It's because of this column additions here, which doesn't seem to want to be cooperating. So after you build this, you set how often you want it to update you. And when new investors, new companies meet this criteria, it will send you an email. So you can see how many additional entries have been added to these different searches after we created it. These are emails that are going to, you know, whoever's running your fundraising process, and you're saying, oh, wow, that is a relevant investor. Let me find their email address and load them into the email campaign that we send out to new potential investors. So again, this process is very much a cold outbound approach to investors that we're big believers in. Anyone that tells you you have to meet investors through direct intros are furthering the problems of inequality within venture and tech, because it is those underserved communities, whether it's minority communities or female founders, that have less connections in that space. And so they are immediately put at a disadvantage. And so cold outreach is a really important part of democratizing venture and startups, in my opinion, and we help companies with it all the time. And so to maybe look at one of these, you can see, you know, we're looking at investors in New York that are these types of investors. They've invested in at least 5 companies, right? That way we know they're active. They are active at seed and early stage, and they're focused on data mining, going back to the Pied Piper example. Again, we are looking at companies, investors that have invested in companies. Those companies have tagged themselves with the industry data mining, and that pulls up this list of investors. So we know that they're relevant if you're relevant as data mining. Another example is, I think I can actually go back here. Here we go. So this is actually a better search. So instead of searching industries, we search description. So in the description that a venture capital fund writes when they add their profile into Crunchbase, they put the terms big data. There are 13 companies. That means that they didn't just invest in some company that happened to tag themselves big data. That means that they wrote big data in their own description. They are really focused on big data. So if that's relevant to you, super tight tie. And then the last one is a company search. We are looking for companies that have raised over 10 million in the US, are active, does not include nonprofit, is better than does include for-profit, because a lot of companies actually don't list their company type. Again, does not include public or delisted, because a lot of the private companies don't actually even include this, and we want them included in this search. And going back to Pied Piper, compression. We're searching for the description, compression, and finding those companies. Player link is one that we pulled up and was relevant but not competitive to what it is that Pied Piper does. And here you can see their investors. Where is the list? Here we go, from the different stages. And we're actually big fans of SAS Capital and Rob Belcher, who is the man. And so, you know, all of these investors, especially these two at the earlier stage, are relevant to Pied Piper trying to raise a seed round. So that is like a really quick run through, you know, of the work we do. We build all this out into actual lists of contacts here. So you can see our top down investor research. This specific fund came up in 7 different searches that we ran. And so then the search count, this overlap, ends up becoming actually a relevant score for the investors. And it's a pretty complex topic. I am well over time, so I'm going to get back to that presentation and rush to the end. This is an example of doing that on a fund's website. Is it ever too early to be engaging with investors? The answer is a hard no. And the reason is because they are able to measure the value of the market you're attacking and evaluate the quality of the product, but they cannot foresee your ability to successfully execute on the plan. And so the team is the biggest risk. You are the biggest risk. Also, they're typically waiting 6 to 12 months from when they first meet a founder to when they actually cut a check. And the reason is because I jumped the gun on myself here. You, don't be offended, are the biggest risk. And so they want to take time to get to know you. And so it's really important for you to actually be impressing them at every stage and every point of interaction with the investor. If you're too early, because a lot of times we have companies that don't meet some of the criteria or don't have the traction that we talked about, the honest way to handle that is to really own it. And this is for sort of sales where you're always putting your best foot forward, and fundraising where you really need to prove that you're trustworthy and that you're open and willing to learn, and will share your weak points so that you can bring in people to help you with them. This is a good example. Hey, Jane, the investor, I know we're too early, but you're such a perfect fit because you invested in this company and that company, and they really overlap with us so well. You obviously have experience and connections in the space. You'd be perfect for us. And so even though we're not relevant to you right now, we will be in the future, and I'd love to keep you up to date. Would you be game to have a meeting? Right? Have a meeting, maybe not. Keep them up to date on what it is that you're doing. Definite yes. And that's how you want to be engaging if you're too early. And how to keep them up to date is something we call the investor prospecting newsletter, which I am happy to explain. If this deck is shared, we take basically an actual investor update, and sort of strip a lot of the detail out of it and make it a more general investor prospecting update. And what this really helps to do is when you're sharing metrics, you're meeting them at this point and then showing them newsletter 1, newsletter 2, newsletter 3. You're really showing that you're growing the company and you're de-risking their view of you as an operator, and creating a better chance that they view you positively and will end up making an investment. So it helps you stand out from the crowd. You end up getting strangers to help you because these are prospective investors that you actually end up asking for introductions to different people, and people love to help, and they do. And it mitigates your perceived risk. That's a link to that. Getting introductions from influencers. Don't be lazy. There's a lot more there. We're VentureOut. We believe that talent around the world is evenly distributed, but opportunity isn't. And we are bridging the gap between innovators around the world and all the opportunities in New York City and the broader US. And we've done that by accelerating over 1,000 companies since we launched in 2012, who have gone on to raise $2 billion in capital, create 13,000 jobs. We do this at scale. We run about 25 to 30 programs a year. Each of those programs has about 25 speakers in it. So we're programming over 500 speakers through these programs every year. And we do a lot of one-to-one work in our advisory practice as well. The actual accelerator programs that we run are 2 days to 1 week intensives built around a sector or a specific country of focus. You can find them on our website. We run 3-month accelerators, which we do virtually, and we do them one-to-one around individual businesses. So if you're interested, please let us know. And we also do one-to-one advisory from sales to marketing to messaging and pitching, US expansion, fundraising, and the rest. Again, my name is Brian Frumberg. See you later. Thanks for listening. Bye.